After working for so many years and putting a lot of effort into creating a life for yourself and your loved ones, a time will come when you have to retire. Now that you are of retirement age, you might have new dreams and goals. You might desire to see the world or spend more time with your loved ones. You may also desire to honor your child's wedding or sponsor his or her education. While all these might be difficult, with retirement planning, you will have the ability to fulfill your desires while preserving your financial independence and confidence. In this video, we will discuss the significance of retirement planning and look at the actions you must take to get ready for your golden years. Thank you for visiting our channel. We will look at retirement planning today and how you may get ready for retirement. Before we go any further, make sure you like and subscribe to receive the most recent information on topics like this. Now let's take a look at retirement planning and see what it's about. Retirement planning involves making preparations for your future so that you can continue to achieve all of your goals and life desires on your own. Watch to the end to discover more about setting your retirement planning goals, determining how much money you need, and making investments to increase your retirement savings. Every retirement planning is unique. After all, everyone has different ideas on how they want to live in retirement. This is what makes retirement planning so important. The world has changed with great advances in medicine and technology, and as a result, people are living longer and can stay fit and active well into their golden years. Sadly, many people lack the savings or investments necessary to confidently retire in their 60s. According to estimates from the Consumer Financial Protection Bureau and the Center for Retirement Research at Boston College, 50% of today's retirees have either cut back on their spending or will soon be obliged to do so because of limited resources. Too many retirees will end up depending heavily on their retirement benefits to pay for the majority of their living costs, only to discover the hard way that they don't have enough. Even though retirement benefits are only meant to cover a third of an average worker's wage, more than 1 in 5 married couples and 45% of single retirees rely on retirement benefits for more than 90% of their retirement incomes. The truth is that while many manage to get by without ever creating and implementing a retirement plan, those who enjoy their retirement the most do so partly because they have one. Planning for retirement will enable you to live comfortably once your employment ends. There are a few questions you should ask yourself when planning for your retirement. Do you intend to retire soon? Do you intend to continue working until you are 65 or beyond? Do you intend to retire early? The length of your active working years has a big impact on how much money you'll require after retiring. Working until you are older not only gives your money more time to grow, but also reduces the number of retirement years you need to save for. Where do you want to reside? Will you downsize or remain in your current residence? If you were to retire, would you want to do so in a warm place, close to your family, or in the same neighborhood? How do you plan to cover your living costs? Will you have a pension? Will you also need to invest or save money? The size of your living expenses itself should be taken into account as another aspect. The amount of your living expenses can vary dramatically depending on whether you own or rent property in retirement. How much money do you need to retire? Sadly, there isn't a single figure that applies to everyone. Follow these simple steps to calculate how much money you'll need to retire on your own. Calculate the entire cost of your annual living costs upon retirement. You can use the generalization that, after permanently leaving the workforce, the average retiree needs roughly 80% of his or her pre-retirement income to maintain the same standard of living. To determine your predicted net yearly living expenses in retirement, take your anticipated retirement benefits and any pension income into account. Your most recent retirement benefit statement, which you may access on the Retirement Benefits website, contains an estimation of the retirement benefit income you're anticipated to receive. Calculate the total amount of money you will need to save for retirement by multiplying your anticipated net annual living expenditures in retirement by 25. A second general rule of thumb, known as the 4% rule, is related to multiplying your projected retirement expenses by 25 to calculate the total amount of retirement funds you'll require. According to this guideline, you should not withdraw more than 4% of your retirement funds each year to ensure that you have enough money to last for at least 30 years. How do you invest and save for retirement? Saving money and investing it are two very different things. Most people invest their money, usually in the stock market, in order to save for retirement. If you just transfer a portion of your salary to a savings account, you are unlikely to achieve your retirement planning objectives. You must put money into assets that will gain in value. To help make this point clearer, imagine contributing $5,000 annually to a savings account earning a 1% return. That account's value would increase to $208,000 after 35 years. However, if you were to invest the same $5,000 annually, assuming a mere 7% average annual return, the account would be close to $700,000. The profits your portfolio generates depend, of course, on the investments you make. We believe that investing in stocks is the best long-term strategy for accumulating and protecting wealth. You might be eager to start putting your retirement plan into action, but before you start investing, you should have 3 to 6 months' worth of expenses set up in a high-yielding savings account. How much money should you save for retirement each month? Well, that depends. Each person has a different amount of money they can save at the end of each month. However, it would be wise to set aside and invest 15% of your income as a starting point for retirement. If setting aside 15% of your income sounds difficult, remember that you don't have to do it right away. If your employer provides a retirement plan and makes matching contributions, you must, at the very least, make enough contributions to your retirement account to be eligible for the entire company match. Aim to save at least 6% of your income if your employer doesn't offer a retirement plan. Then you can work on raising that amount. Until you reach your desired contribution rate, try to gradually raise the portion of your income that you set aside for retirement savings by 1% each year. When your pay increases, you can also increase your contribution rate. There are different kinds of retirement plans, which thankfully gives you a wide range of excellent options for achieving your retirement planning objectives. Retirement plans are divided into 4 categories: pension plans, self-employed retirement plans, employer-sponsored retirement plans, and individual retirement accounts. The employer-sponsored retirement plans are typically created by employers and offer the advantage of employer matching contributions. These plans, which are all sponsored by employers, include a 401k retirement plan, which is a retirement plan with tax-deductible contributions. Remember, though, that the withdrawals from the plan are treated as ordinary income for tax purposes. A 403b retirement plan, which is similar to a 401k plan, but is exclusive to public schools, charities, and ministries. A 457 retirement plan, which is also comparable to a 401k, but is only accessible to employees of state, local, and some highly compensating nonprofit organizations. A thrift savings retirement plan, which is exclusive to employees of the federal government and members of the uniformed services. It is comparable to a 401k. These are all various forms of employer-sponsored retirement plans. Now let's take a look at the other plans. Pension plans are sometimes known as defined benefit plans because they offer a fixed, predictable amount of money each month for the rest of your life once you retire. Although many employers in the public sector still provide pension plans, private companies that offer pension plans are very rare. Individual retirement accounts, or IRAs, is divided into 2 different types, and while they differ in timing, both of them offer tax benefits. The first type is the traditional IRA, which is a retirement plan that allows tax-deductible contributions and counts withdrawals as ordinary income for tax purposes upon retirement, and the second is a Roth IRA, which is a retirement account in which contributions are not tax-deductible. What if you're self-employed? How should you plan for retirement? Although retirement planning for the self-employed may require some administrative work, self-employed people have various options to access many of the same tax benefits offered by employer-sponsored retirement plans. The following retirement accounts are accessible to independent contractors. The Simple IRA, which is short for Savings Incentive Match Plans for employees. Simple IRA plans are for companies with fewer than 100 employees. The SDP IRA is short for Simplified Employee Pension. Employers are required to contribute 100% of the funds to the accounts under the Simplified Employee Pension IRA and to offer the same benefits to all qualified employees. You can also use the Solo 401k retirement plan, which is comparable to employer-sponsored 401k plans, except it has a greater annual contribution limit. Investors who are preparing for retirement typically have the option of paying taxes on their contributions to a retirement plan and receiving the money tax-free in retirement, or making pre-tax contributions to a retirement plan and paying taxes on withdrawals in retirement. If you think your future income needs will put you in a higher tax bracket than your current salary, choosing a retirement plan that offers tax benefits in retirement is typically the best choice. Retirement plans that offer tax advantages in retirement are called Roth variants. Although Roth IRAs and Roth 401ks are frequently used, you should also think about a Roth 403b plan, a Roth 457 plan, or a Roth Solo 401k. You might be able to avoid paying state taxes on withdrawals, even if you have a 401k or a traditional IRA. Your income from these sorts of retirement plans is tax-free in some states. Planning your retirement approach is crucial, but shouldn't cause you stress, especially if you begin early. Remember the saying, the early bird gets the worm. You can consult a certified financial planner or another knowledgeable expert for guidance if you need help figuring out your ideal asset allocation, predicting when you can retire, or arranging your retirement income strategy. The most crucial thing is that you carefully consider retirement planning and begin in earnest right away. We hope you enjoyed this video. Retirement can be a very exciting time, but it can also be very stressful if not well planned for. Hopefully, with the tips we've shared, this process may become easier for you. Keep these tips in mind, and you will be well on your way to a successful retirement. If you enjoyed this video, please like and subscribe. Thank you for watching.